Professor Zhao at MTSU. In this chapter, we'll go through option valuation, and more specifically, we will go through Black-Scholes option pricing model, protocol parity, binomial tree method for option pricing, as well as Monte Carlo simulation approach of option pricing. Let's get started. As we know, option value has two components. The first one is intrinsic value, and the other one is time value. The intrinsic value equals stop price minus exercise price for a call option, and that is the profit that investor could realize by immediately exercise in the money call option. And for all of the money option, investor don't have to exercise a call option, and the payoff should equal to 0. So this intrinsic value is equivalent to the payoff of a call option or put option. And the time value is the difference between option price and the intrinsic value. Time value reflects the value of option where future uncertainty may add value to an option. As long as the option is not expired, there is certain amount of time value, no matter it's for in the money option or out of the money option. So option price equals intrinsic value plus time value. Now let's take a look at this picture. This picture shows you the relationship between intrinsic value and the option price. On the x-axis, that is stock price. As you see, this S0 is the current stock price, and also you see X on the axis of stock price, that is the strike price. On the y-axis, that is the option value. And here, as long as stock price is higher than the strike price, it's called in the money option. In the money means that investors can make money by exercising option. So the payoff of in the money option follow this gray 45-degree line. 45-degree line. It equivalents the difference between stock price and this exercise price. For the out of the money option, investor don't need to exercise the option, because exercising option means losing money, but the option is the right that investor had, and he or she doesn't have to if it is out of the money option. So in this case, investor simply let it go, and the payoff should equal to 0. So between 0 and X, you see a flat line, that is intrinsic value for out of the money option, or equal to 0. So this 45-degree line plus this horizontal line between 0 and X is the intrinsic value in an option. Or we can say this is the payoff of an option without consideration of option price. Right? And the option price is always higher than this intrinsic value. As you see, option price is represented by this blue curve above the intrinsic value, and the difference here is the time value. Let's say the option right now is out of the money. The intrinsic value is equal to 0. Would the option price equal to 0 in this case? The answer is no. Why is that? Because in the future, there is a chance that stock price may increase to a level that make option in the money. So the uncertainty of stock price actually increase the value of the increase the time value of an option. As long as the option is not expired, there's always time value attached to an option. As you see, time value tend to be a large number when option is close to if option is about at the money, or around at the money around the money point, and when option is deep in the money or deep of the money, time value tend to diminish. So this picture fundamentally shows you that the option value has two components. The first one is the intrinsic value, represented by this 45-degree gray line and this flat line between 0 and x. And also the time value of an option. And the previous picture showed you the relationship between stock price and option value, that is for a typical call option. As you see, higher stock price, higher the value of an option. But in practice, people also found that there are many other factors have a relationship with option price. Other than stock price, exercise price, or the X, volatility of the stock, the time to expiration, and the interest rate as well as the dividend rates all have relationship with option price. This table showed you the relationship between 6 different factors with the option price. And those 6 factors are stock price, exercise price, volatility, time to expiration, interest rate, as well as the dividend payouts. And as you see that the relationship between those variables and the value of a call option is basically positive except for 2 factors, the exercise price X and the dividend payouts. And traditionally speaking, people always say that the 5 factors affecting call option. That is true. But how come we have 6 factors here? Well, the 6th factor here, dividend payout, typically is not a determinant for call option if call option is dividend protected. And nowadays on the market, most options are dividend protected. Well, what does that mean? Well, let's say you buy a call option and you believe that a call option value has something to do with the intrinsic value of the stock. But the company may pay dividends, right? And when company may pay dividends, stock price will decline. In that case, option price will decline. And it's kind of unfair for investors who bet on the bearish trend of the stocks simply based on dividend payment, because dividend payment shouldn't be a bad news for the stock. So on the market, most options are dividend protected, so the dividend is not affected. That affect the dividend protective call option price. And most well-known 5 factors affecting call option or put option prices are stock price, exercise price, volatility, time to expiration, and interest rate. And all 5 factors tend to have positive relationship with both a call and a put option, except one factor. Right? That one factor is exercise price for call option and stop price for put option. It is a negative relationship. So in case of call option, the higher the exercise price, lower the option value. And in the case of put option, higher the stop price, lower the put option value. Right? So we have 5 basic factors actually shapes an option price. So let's take a look at a well-known option pricing method that is called a Black-Scholes option pricing formula. And this formula was a research article made by Dr. Black and Dr. Scholes, and back to 1970s. Dr. Black, who is a mathematician, and Dr. Scholes, who is a finance professor. They work together. Together to solve the option pricing problem. And before 1970s, people recognized there are 2 components in option pricing: intrinsic value and the time value. Although intrinsic value can be quantitatively determined, but it's really hard to capture the time value. And people actually developed many theories and models trying to find an equilibrium formula that they can utilize to calculate option price. But those formulas are not very successful because most variables that researchers utilize in their formulas are not observable on the market. And sometimes people use variables such as investors' expectation, right? Risk averse, the degree of risk averse on the market. I mean, in theory, you can define those variables, but on the financial market, it's really hard to quantify those variables. Right? And also, people recognize that there are 5 basic factors affecting option price: stock price, exercise price, the volatility of the stock, interest rates, so on and so forth. But nobody ever found a reliable way to price an option until Black-Scholes developed this great option pricing theory based on their non-arbitrage equilibrium analysis approach. So let's take a look at what Dr. Black and Dr. Scholes did back to 1970s. And here, option price, as we know, option price is a function of future stock price, right? Higher the stock price, higher the intrinsic value for a call option, right? So option price is a function of future stock price, but a future stock price is unknown to anybody. So here we essentially need to solve for option price based on something that we don't know. So traditional cash flow discounting model doesn't work well in this case. We have to find alternative way for option pricing. Their alternative way is based on non-arbitrage pricing approach. So what is a non-arbitrage? Non-arbitrage is a very powerful assumption on the financial market, right? As we learned in the past, that there's a law of one price principle, which means for the same assets, if it's traded on the different places, then it has to have the same value. Otherwise, there will be arbitrage. And the competition among arbitrageurs will eventually push those two prices to the same level. So that is a non-arbitrage argument, right? And the same assets should have exactly the same prices no matter where it's traded. And this option pricing, Black-Scholes option pricing formula is simply based on this non-arbitrage argument. So here are 5 steps that Dr. Black and Dr. Scholes utilized to solve their option pricing problem. First of all, they establish a risk-free portfolio that has a long position stock and a short position in call option. Well, when you combine a long position stock and a short position call option, you see that future gain or losses can be offset each other to a point that the portfolio can be considered as a risk-free portfolio. You see, right? Say you have 100 shares stock price increase, so the value will increase. But meanwhile, you have a short position of option, and the short position of call option will generate losses when stock price is increasing. So in this case, the profit of your stock holding will offset with the losses in your call option. They cancel off each other completely, leaving the value of your portfolio a constant number. So we call this as a risk-free portfolio, right? And the second step is to figure out the return on this risk-free portfolio. Right? If a portfolio is risk-free, then what will be its return? Before Black and Scholes, many financial researchers back to late 1960s and 1970s mistakenly believed that risk-free portfolio should earn 0 return, but actually that is not a good argument, because risk-free portfolio should earn risk-free rate based on our understanding of risk-return trade-off theory. And then the third step, here you have a risk-free portfolio, and the return on this risk-free portfolio equals risk-free rate. And here you have a formula. But this formula is pretty complicated because it's not just the left side equal to right side, right? And the real problem here is when you need to form this risk-free portfolio, you need to find so-called hedge ratio. The hedge ratio is the ratio of number of call option and the number of stock in your portfolio, so that this portfolio can be established in a risk-free basis. And the problem here is that hedge ratio tend to change all the time. Tend to change all the time. When stock price changes, that ratio need to be changed. When time goes forward, that ratio tend to change. So the hedge ratio is a dynamic term that we need to define, and the definition of this dynamic term for hedge ratio can be formulated by using partial differential equation. And if you are a business major, this might be a completely new thing to you. But for engineering students, for students who majored in mathematics or physics, it's not a very a challenging term. Partial differential equation is just a very simple thing that they deal with for their advanced engineering classes or advanced mathematical classes. And the solution of partial differential equation is not unique. In most cases, there might be a set of solutions based on partial differential equation. But once we impose so-called boundary conditions, then a set of solution can be reduced to one unique solution. That is solution for option price. And the boundary conditions here is, what is the boundary condition? The boundary condition is the intrinsic value of a call option or put option, right? And it cannot go beyond the intrinsic value, right? In terms of the lower bound of option price. That is the boundary condition. So when we solve the partial differential equation subject to boundary condition, then option pricing problem can be solved. And solving this partial differential equation needs a special technique. That technique is heat exchange equation. And so here we are combining mathematics, physics, and understanding of the nature of option pricing in order to find this dynamic hedging approach to solve for option price. And in the fourth step, once you apply the heat exchange equation, you can solve for this call option formula. And the last step is to apply the put comparative to solve for the put option price. Right, so this is a path-breaking research outcome by Dr. Black and Dr. Schultz back to 1970s. And initially they had difficulty publish their research paper, but later on people recognized that their finding is path-breaking. It changed the way we understand how this financial market works. Although it's a small piece of work specifically related to option pricing, but the results based on this option pricing model change the way that we view this financial market. And essentially speaking, no matter how complicated a financial asset is, we can always view that asset as one unique type of option. So no matter it's a stock, a bond, the value of corporation, real estate, everything, basically everything can be viewed as a special type of option. And we can use option pricing formula to find the value of virtually all kinds of financial assets. That's why Black-Scholes option pricing formula helped those two researchers to receive Nobel Prize in 1997. By the way, it is not Black and Scholes got a Nobel Prize in that year. It is Dr. Merton and Dr. Scholes received the Nobel Prize in 1997. Why is that? Well, here I want to tell you a little story about Black-Scholes option pricing formula. Dr. Black and Dr. Scholes are professors in University of Chicago, and Dr. Black is a mathematician, and Dr. Scholes is a finance professor, and they work together to find this magic formula for option pricing. And meanwhile, other researchers work very hard, working on option problem as hard as Dr. Black and Dr. Scholes, and notably Dr. Merton, who work at MIT, also found a similar solution, but based on very different equilibrium analysis approach. While Dr. Black and Scholes, they utilize non-arbitrage pricing mechanism for the option pricing research. Dr. Merton actually utilized a very traditional economic equilibrium analysis. And although they were on the two very different paths of research, but they reached a very similar conclusion for option price. Right. And in 1997, both Dr. Merton and Dr. Scholes received Nobel Prize for their contribution to option pricing, but Dr. Black couldn't. Why? Because Dr. Black died before he can receive Nobel Prize. So why Dr. Black died so early? Well, first of all, he's older. He's older than Dr. Merton and Dr. Scholes, but more importantly, the factor that leads to Doctor's death is that he worked too hard. He worked too hard when he was young. Once he and Dr. Scholes figured out how to price an option, and actually he utilized dynamic hedging mechanism to find various ways to make money on financial markets. And actually he was hired by one of the best investment banks, Goldman Sachs, back to 1970s and the 1980s. And he made a lot of money as research head of their arbitrage trading unit. So what he does and what he and his team does is utilize dynamic hedging mechanism to find out arbitrage opportunities on the market. He make millions each every year, but as you know, investment bankers need to work really hard to earn big money. So Dr. Black actually died before he can receive the Nobel Prize because he worked too hard. And while Dr. Black makes a lot of money based on his smart approach of dynamic hedging, Dr. Scholes and Dr. Merton feel very jealous. And they were inspired by Dr. Black's career at Goldman Sachs, and they wanted to utilize the same skills to make big money. So in early 1990s, Dr. Scholes and Dr. Merton actually co-founded a hedge fund called the Long-Term Capital Management, LTCM, Long-Term Capital Management. And this hedge fund did not invest in stock bonds like other mutual fund or hedge fund does, and they simply invest in arbitrage opportunities that they can discover by utilizing dynamic hedging approach. They do all kinds of arbitrage, right? And their strategy was very successful, and they can deliver around 30% of return each every year, and good performance actually was persistent for almost 5 years since establish of the long-term capital management. And in 1997, both professors received Nobel Prize, and they become more famous than ever. Although they have a lot of students actually work on Wall Street, and it's not a big issue for them to attract new customers. But after 1997, more and more investors actually go to that firm, ask Dr. Black, Dr. Schwartz, and Dr. Merton to manage their money. But in 1997, that really bad thing happened for this hedge fund called long-term capital management, and they actually got billions dollars losses in a very short time period, right? Because their arbitrage strategy actually went south when Russia government defaulted on their treasury securities, and it caused the tsunami not only in Russia but also in America. It affected American treasury security prices. So based on their arbitrage approach, I mean, if it's a normal situation, there's no problem. They can capture the risk-free profit. But when market went south, their position were broke. And their position is based on high leverage. Sometimes they leverage, their leverage ratio could be 10 to 1, 20 to 1, or even 100 to 1. The high leverage in their non-arbitrage portfolio actually lead to huge amount of losses in a very short time period. And at a certain time, the Federal Reserve had to intervene in this event, and they organized investment syndicate to buy out this troubled long-term capital management. And they just cannot let this hedge fund to fail, because the counterparties of the hedge fund are investment banks, large commercial banks. If the authority allow long-term capital management to fail, then all other banks will get into very messy situations. So this is another example of too big to fail, because if you allow one critical player on the financial market to fail, then all their counterparties in the financial contracts will be negatively affected. Right? And let's say, one financial institution in trouble is okay, but if you have a group of all large U.S. banks, the U.S. investment banks are in trouble, then this financial market may collapse. So the Federal Reserve of New York in 1997 actually intervened in this event, and they organized investment bank syndicate to buy out long-term capital management and let this company to survive for a couple of years. And once the crisis is over, they actually closed out position without having to take large losses. But Dr. Schwartz and Dr. Merton lost their job as co-founder of the company. But anyhow, they made huge impact, not only in research of this option pricing formula, but they made a huge impact on Wall Street. Both of them made a lot of money. So that is a little story behind Black-Scholes formula. And if you are interested, you can watch a video called Black-Scholes option formula on YouTube. And it's a movie filmed by BBC back to 1998, and tells you a very interesting story about the Black-Scholes formula and how Dr. Merton and Dr. Schwartz involved in their financial business, as well as the long-term capital management crisis in 1997. Very interesting movie. Now, let's take a look at this Black-Scholes option formula. Black-Scholes formula. Oh my God, you don't want to look at it. It's so complicated. You have to be PhD in physics or mathematics in order to understand it. But actually, let me do a little interpretation, make it a little easier for you guys. All right. First of all, here you see a lot of letters: C, S, T, D1, D2, S, K, R, square of standard deviation, so on and so forth. It looks very complicated, I agree, but no matter how complicated, you will notice that only 5 factors are here. Only 5 factors are here. First one is stock price, S. And the second one is K. This is the strike price or exercise price. The third one is R, interest, which is a risk-free rate. And the fourth one is standard deviation. Standard deviation measures the volatility of underlying assets. and also we have t, big T minus small t, that is time left in an option or time to expiration. Right? And let's start with the first line. C means call option, and here we have S and T in the parenthesis, and T means call option at a certain time, and S is call option when stop price equal to a certain number, or S. S here is stop price, T is the timing of call option. So this call option equals two components. First one, you have ND1 times S and minus ND2 times K, and a very complicated term after that. So here, let's simplify this as S minus K. S is stop price, K is exercise price. What is that? Stop price minus exercise price, that is the intrinsic value. Intrinsic value when the option is in the money. Right? Intrinsic value of the option when it's in the money, which is this gray 45-degree straight line. It's a stop price minus exercise price. Right? But in order to apply this equation, we want to make sure that option is in the money. So here we have ND1. ND1 is a probability measure. And this ND1 measures the probability that option will be in the money in the future. You cannot say option has to be in the money or out of money in the future. Nobody knows, but here we can apply certain probability, which is ND1. ND1 measures the probability that option will be in the money. In the case, call option intrinsic value equals S minus K, right? And this ND2 measures the probability that option will be out of the money. If it's out of the money, then option intrinsic value should equal 0. And this K is the strike price. And the term after this K is pretty nasty. E, that's natural. The exponential function, natural exponential function, right? E raised power of minus R. R is the interest rate times T. Big T minus T, that's time left in an option. What is that? E raised power minus RT. What is that? That is simply that the way that we utilize to calculate the present value of this K. So K times E raised power minus RT is equivalent to the present value of the exercise price, or X, the exercise price. When you calculate stock value, you need to apply the exercise price in the future. And the current value option should incorporate the present value of the exercise price. So this E raised power R minus RT gave you a way to calculate the present value of K. You might ask why it's so complicated. The present value of K can be calculated as K divided by 1 plus R raised power T. Right? That's how we do present value calculation. But here it's all about the assumption of compounding cycle. Right? As we know, if we use the equation of K divided by 1 plus R raised power T, we assume that the compounding cycle is on an annual basis. Right? But interest rate can be compounded on an annual basis, the monthly basis, daily basis. It's typical practice for a mortgage banker to calculate interest on a daily basis. But here, our assumption on this perfect financial market is that interest need to be compounded on a continuous basis. The continuous base compounding means that the time interval is basically 0. It's something less than 1 second, less than 1/100th of a second, or maybe 1/1,000,000th of 1 second. So that is continuous compounding assumption that need to be incorporated in this option pricing theory. And for continuous compounding assumption, we need to use this E raised power minus RT as a way to do the discounting. and the way that we need to do the discounting. So K times E minus RT is simply the present value for the strike price. Right? And we have two probability measures here, ND1 and ND2. ND1 measure the probability that the option will be in the money, and this probability has something to do with all 5 factors. So D1 equals log function of A's stop price divided by strike price plus R risk-free rate plus square of standard deviation divided by 2 times T, and then entire term is divided by standard deviation times square root of T. And I mean, you cannot say anything about this. Why this has to be this complex? Just the derivation results of the Black-Scholes formula, right? And I mean, you can say this probability measure has something to do with stop price, exercise price, risk-free rate, standard deviation, and time left in an option. And D2 follows another equation, and it equals D1 minus sigma times square root of T. Once you get a D1, D2 are probabilities. Let's say D1 equals 53%, D2 equals 35%. It's in percentage. And ND1 is cumulated probability, distribution. And this picture showed you basic idea of this ND1, right? So this ND1 showed you the certain areas covered up to this D in the framework of this standard deviation, standard normal distribution. And this ND1 measures the total area up to the point of D, and it's called a cumulative probability distribution. And ND1 and ND2 are two probability measures that we utilize to estimate the probability that option will be in the money or out of the money. And actually, we utilize both terms in option pricing formula. So now let's take a look at an example on how we can use this Black-Scholes formula to calculate option price. And here is a spreadsheet, and in column A and B, you actually put values for those 5 basic factors: standard deviation, T expiration, time to expiration, R risk-free rate, stop price S, and exercise price. So that is the input area for option pricing calculation. Then based on the 5 factors, you can calculate D1 and a D2, and based on D1 and D2, you can calculate a probability measure ND1 and ND2. Once you get ND1 and ND2, apply the equation to get call option price. Right? Now let me show you how we can utilize Excel spreadsheet to estimate option price based on Black-Scholes formula. And here I designed a very simple spreadsheet model to calculate option price. And in this yellow box, you see 5 inputs of option pricing. The first one is stop price, second one is strike price, third one is standard deviation, fourth one risk-free rate, and the last one is T. Right? And let's say we have a stock current price $8.38 and a strike price $9, and the volatility of the stock is assumed at 78%, risk-free rate of 5%, and let's say the 3 months left for option to expire. Once you have 5 factors, you can build formulas here to calculate D1. As you see, D1 is based on a formula, and this formula is the one that you see here. D1 is a function of 5 factors, and I can put this equation in the cell of Excel spreadsheet. Both D1 and D2s are based on formulas that you learn in the textbook. Then we can use both D1 and D2 to calculate the probability measure of the ND1 and ND2. And there is Excel function that you can utilize here to calculate ND1 and ND2. That is norms DIST, normal distribution function. Right? And here we got ND1 and ND2. And in this cell, call option price, in this cell, we just put the call option pricing formula based on Blackshaw's research, right? ND1 times stop price minus ND2 times the strike price. Then we do the continuous discounting. This EXP is the exponential function of that continuous discounting function. And here we can get a call option price. And I also have some attached small table showing you the intrinsic value versus time value. In this case, the option is out of the money. The intrinsic value is 0. So the time value equals call option price. Right? And once you get a call option price, how do you get a put option? Well, in this case, I apply so-called put call parity. Or based on put option price to get a or use put option formula to get a put option price. And here, I can use both. I can use put option formula or utilize put call parity to solve for the put option price. And the last small table here shows you the put call parity, which we will discuss a little bit later. Right. So once we get call option price, it's time for us to figure out how to calculate the put option price. And the put option price is very easy to calculate it, simply based on put call parity. Let me show you what is put call parity. Well, the put call parity is a relationship between call option price and the put option price. And this relation is very strong because once it's violated, then it will generate arbitrage opportunities. So the competition among arbitrageurs will enforce this relationship between call option and the put option. Yeah. And the relation looks like this. The difference between call option price and the put option price must equal to the difference between stock price minus the present value of the exercise price. So on the left, that is call option price minus put option price. On the right, that is the difference between stock price and the present value of the strike price. Right? And for dividend paying stock, if it's not dividend protected, then it follows another equation. But here we simply focused on this simple put call parity. Right? And how can this work? Well, this table showed you this relation must hold, otherwise there will be arbitrage. Right? So here we can view this equation in a very practical way. And let's say you have a position. Where you have a combination of call option, put option, stop position, and a lending and a borrowing. And right now, you have call option price of $14 and a put option price of $5. And the stop price is $110. And the risk-free rate is assumed as 5%. Right? So when you see all those numbers of the financial market, what can you say? Well, I mean, once you have several numbers in your mind, you would say, I don't know what's going on here. But if you are smart, and if you know a little bit about this protocol parity, I can tell you that you can make a lot of money by doing so-called arbitrage. Right? So how come you can figure out you can find arbitrage opportunity? Arbitrage is great because it means millions and millions dollars on the table you can grab without taking any risk. Right? That is great. Just that you need to figure that out. Right? So here, what you need to utilize is a very simple principle called the protocol parity. And you look at the call option price, put option price, and here call option price $14, put option price is $5. The difference is $9. All right, and you know this number has to equal to stop price minus the present value of strike price, the strike price. Right? But actually, the difference is not $9. It's not $9. Right? And the stop price is $110. Let's say strike price also 110, and the present value of the exercise price is $102.41, and the difference is $7.69, not $9, not equal to $9. So I mean, on the left side you have $9, on the right side you have $7.60. I mean $7.59. It doesn't equal to each other, and if it doesn't equal to each other, then this protocol parity is violated. When the principle is violated, what can you say? You say that is sad. Financial principle is violated. That's sad. But I would say you should feel very exciting as an investor, because when the law of one price is violated, this financial market gives you great arbitrage opportunities. You can grab money from the table without taking any risk. That is great. So here's the money. Here's the money. The difference between the left hand side and the right hand side equal to $1.41. And you can build a portfolio that can allow you to grab this $1.41 for free. Right? Without taking any risk, okay, in this portfolio, you buy a stock, $110, right? So you need to spend $110, but you do not spend your own money. You borrow money. You borrow $102.41 to finance majority part of your stock purchase. Right? So here you only spend like $7.59, and you continue to sell a call option. When you sell call option, you receive $14, and you buy a put option, which I mean in this case you spend $5. So after all the tradings, in your hand you get that 141. You can say it's $1.41, but I can say this is 1.4 million or 1.4 billion US dollar, because this is a risk-free portfolio. You can go as much as you can. And once you get this $1.41, what should you do about the money? I mean, you are very not certain about what will happen in the future for this portfolio, but I would say don't worry. This is a risk-free portfolio, because in the future, no matter what will happen, there is no liabilities. There's no liability associated with this portfolio. You will always generate zero gains, zero losses, no matter what happens. All right? And you can see, I mean, from this table, you can see that, okay, let's say future stop price can be either greater or less than $105. Right? And then, I mean, the money that you bought, the exercise price is $105. And here, I mean, since you borrowed the present value of exercise price, in the future, you need to pay out $105. Right? And stop price can be lower or higher than that exercise price. If the lower the exercise price, then call option, the value for call option will decline to 0. And the put option will generate the payoff 105 minus ST, and when you put everything together, man, it's equal to 0. And when stock price is greater than $105, it's the same. It's the same because all the gain or losses generated from individual position in this portfolio, they cancel off completely. Right? Give you zero payoff in the future no matter what happens. This is a risk-free portfolio. So what would you do with that 141? It could be 141 million US dollars. I would say that is your money. That is your risk-free profit. Feel free to spend it. Right? So that's how this arbitrage strategy work in the context of put call parity. Right? You would say, hey, I love that arbitrage profit, but keep in mind that a lot of people on this financial market are equally smart. When you see this opportunity, other people will see it. And there will be competition to grab that risk-free money on the table. Right? And a lot of people will do the same thing. They buy stocks and they borrow the present value of the strike price, sell, call, buy, put. But once more and more people involved in this process, call option price will decline, put option price will increase, right? And also stock price will increase because so many people are buying stocks, and the price will change to a point that the arbitrage opportunity will be gone, will disappear. When will that happen? Well, when put call parity is held. When put call parity is held, there will be no arbitrage opportunity. And actually, it is competition among the arbitrageurs. Actually, push the price of the call price and the put price to the level that you see in the put call parity. So put call parity is a very strong relationship. It must hold, otherwise there will be arbitrage. And it is the competition among arbitrageurs actually help to hold this equation. Alright, so put call parity. Call price, put price, stop price, and the present value for the exercise price. Right, once you know call option price, you can calculate the put option price. Put option price. And actually, this put call parity also show you how we can replicate different type of options. And here you see option, call option equals S0 minus present value of X and plus P. That means that call option can be replicated based on holding of stock, borrowing of money, and put option. If you combine stop position, put option, and a lending and borrowing practice, then that portfolio actually replicates a call option. And a put option can also be replicated by building a portfolio that contains stocks and options as well as lending and borrowing. So both call and put options can be replicated. Can be replicated based on a portfolio of other security holdings. And here is the Black-Scholes formula for put option, and it's pretty complicated. And in this case, I always prefer to use put call parity to get a put option price once we know call option price. Right. So in this spreadsheet, you see that this put call parity is always held in the context of Black-Scholes option pricing formula, right? C minus P, that is a call option price minus put option price, and here is stop price minus the present value of the strike price. So in the future, I think you can utilize this equation. You can utilize this spreadsheet to calculate any option prices. You can change. You can put anything in this yellow box, and those are inputs for a stock option. Let's say stock price $24, strike price $25, volatility let's say 30%. Right, standard deviation. Risk-free rate right now 0.025, 2.5%. Time to maturity, let's say 3 months, that is quarter of a year, or you can say 6 months. And here, once you put the inputs here, this spreadsheet will allow you to get call put price immediately. And also it show you the breakdown of intrinsic value, time value, and also show you the put call parity. Very useful tool that you can utilize at your discretion. Right? So among those five factors, I mean, the great advantage of Black-Scholes formula is this formula is practically useful. I mean, before Black-Scholes option formula, there were a lot of models that financial researchers utilized to estimate stock price, but those formulas contains variable that is not available, not observable on the financial markets, like homogeneous investors' expectation, right? And the momentum in the GDP, so on and so forth. I mean, those things are very hard to capture on the market, and the great advantage of Black-Scholes formula is that variables that you put in the formula are the number that you can see very clearly on the market. Alright, first of all, current stock price is very clear. It's given. Stock price is given at any given point. It's not future price, but the current stock price. And the strike price is another variable that is 100% given. It's in the contract of the option. Right, strike price. And risk-free rate is pretty clear. And right now, risk-free rate is on the level 2%, 2.5%, and it's you can use 10-year T-note rate as a proxy for risk-free rate. And the time to maturity is also a given variable for any option contract. Right? So I would say among the five factors, you can definitely find four of them: stock price, strike price, risk-free rate, time to maturity. All four numbers are given. Only thing that you need to think about is this volatility. And here I put it like a 30% here, but I'm not very sure about what number this volatility should be. I simply did some estimation, right? What is volatility? Volatility is standard deviation stock return. And actually, we can look at past data of a stock, and to get a standard deviation, we can actually calculate standard deviation for stock return. Let's say during the last 3 months, last year, last 5 years, so on and so forth. Right? But in this equation, I want you to know that the volatility is not the past volatility. It should equal to the future volatility. So this is the only factor that investors needed to estimate before they can get option price. They need to estimate the volatility of stock. Then utilize this option pricing formula to calculate option price. You see that? Because all four factors are given, but the only thing that you needed to think about or estimate is this volatility, the standard deviation. And typically people look at the past standard deviation and use that as a good estimate of future standard deviation. Let's say you have 3-month call option price to estimate. All right, that's a future 3 months. So most people will look at standard deviation during the last 3 months and use the same number as estimate of future standard deviation. That's a reasonable estimation. But always keep in mind that in the future, standard deviation can be higher or can be lower. There's no guarantee that you can get 100% accurate estimation for standard deviation. All right. And actually, the most important aspect of this Black-Scholes option pricing model is the relationship between the standard deviation and the option price. Alright, all four factors are given. Only thing that you are not very sure about is standard deviation. And actually, this standard deviation is the number one determinant of option price. And in some extent, we can say that a call option is function of its risk. A call option is option price is the price for risk, and this the risk is measured by this standard deviation. All right. So the relationship here can be viewed as relationship with investors' expected standard deviation or riskiness of the stock actually determine the call option value. All right. So we can simplify this Black-Scholes formula into a very simple relationship between standard deviation and option price. Option price. Right. And on the market, people actually utilize Black-Scholes formula in the opposite way. Because in the market, we can observe option price. Given we know 4 other factors, we can estimate. We can actually calculate the volatility. And here I show you example on how to use Excel spreadsheet to look at the volatility, the standard deviation by using the go-seek function in Excel. So given we know call option price equal to $7, right? And given we know 4 other factors, then we can look at the value of this standard deviation. And this standard deviation is the expected volatility expressed by investors on the market. That is, investors' opinions on the future volatility of the stock. And this volatility can be calculated by utilizing the stock price. The option price that you observe on the market. And actually, we call this as implied volatility. And simply put, this implied volatility is the volatility implied by the current option price. Right? On the option market, you always see opinions. Investors trade opinions. And a certain option price reflects certain opinion. And here, the opinion is opinion on the future volatility of the stock. So this $7 option price actually reflects certain amount of standard deviation or certain amount of volatility for that stock. That is a implied volatility. And we can look at overall volatility of market by looking at implied volatility. For an option that makes S&P 500 as underlying asset. And as you see, volatility changes a lot, especially when the market going through some financial crisis. You see a sudden spike of the implied volatility in the S&P 500 index. And here you see, Gulf War, long-term capital management crisis, 9/11, invasion of Iraq, subprime credit crisis, U.S. Government debt downgrades, and those critical moments, you see the market actually experience tremendous amount of increase in its volatility, and that volatility is reflected in the pricing of S&P 500 option. Right? And we can look at implied volatilities of the market index. And actually, when the market going through a difficult time or going through a crisis, you see the spike of implied volatilities. When we use the Black-Scholes formula, I think the most important thing that you need to know, this is essentially the relationship between volatility and option price. And from option traders' perspective, you need to be very careful about one critical number, which is ND1 in the call option pricing formula. ND1. This ND1, as I said, this ND1 is a probability that option will be in the money in the future. Just a probability measure, but this ND1 has other meaning. It's also called the hedge ratio. Right? Also called the delta. I mean, it's the same thing, but this ND1 actually showed you 3 different aspects of option pricing. First of all, it is equivalent to so-called hedge ratio. That is the ratio of stock versus options in your risk-free arbitrage portfolio. And also, this same number is the probability that the option will be in the money in the future. Right? And the third, this same number also show to you the sensitivity option price subject to price change of the stock. And we call this as delta. As delta. It measures the sensitivity of option price against stock price movement. So this is a very, very important variable that option traders pay a lot of attention to. The hedge ratio, delta, ND1, the probability that option will be in the money, they are the same thing. They are the same thing. Right, so this is a Black-Scholes formula. Very, very interesting method that Dr. Black-Scholes utilized back in the 1970s to solve the option pricing problem. And it's the first closed form solution for option pricing. Closed form means there's a one unique solution for option price, right? And based on those observable market variables. So when you apply this Black-Scholes formula to calculate option pricing, you would feel very confident because what you're using is a very famous Black-Scholes option pricing formula, and they got a number of price based on this, and a lot of option traders are utilizing this formula on a daily basis, right? You'd assume that it must generate 100% accurate answer, but I would like you to know that in 9 out of 10 cases, the price that you get from this formula would be different from the market price of option. Right? And Black-Scholes formula can only give you approximation of option value, but it will never achieve 100% accuracy. Why is that? And there are many factors contribute to the difference between market price and one that you can get from Black-Scholes formula. Right? And in some cases, Black-Scholes formula will give you biased option price. Why is that? Well, here's why. First one, the model assumptions. There are, in addition to non-arbitrage argument, there are attached assumptions in the Black-Scholes formulas. Right? And those assumptions may not be valid. Let's take a look at those assumptions. In Black-Scholes formula, the risk-free rate is a constant number, which means it will not change. Let's say for the future 3 months, this number will not change. Right? It should stay at 2% level or 2.5%. It will never change. But this is invalid assumption because you never know how risk-free rate will change in the future. It's very likely that risk-free rate is not a constant number. Instead, it's dynamic. It's dynamic term. And also, stock price volatility is a constant number in the formula, but the chance that stock volatility will change, the standard deviation, is another dynamic term in the future. And the third assumption is the log normal stock return distribution. We know stock price can go anywhere, but the stock return tend to follow log normal distribution. However, in reality, you will see the jump and diffusion of stock returns, which is not 100% a thing that can be represented by log normal distribution. Right? And also we have assumption of no transaction costs, no dividend, no restriction on borrowing and lending, and no short selling as well. But a certain investor can do something about short selling. Of course, there are restrictions on lending and borrowing, stop paying dividends. Of course, there are transaction costs. And this financial market is not 100% perfect place. And more importantly, Black-Scholes formula only deal with the European style option. European style option only allow option to be exercised on the expiration date. But in America, we have a lot of American options which allow investors to exercise option anytime they want, as long as it's not expired. So people actually tried how to get solution for American option based on Black-Scholes formulas approach. But no matter how hard people tried during the last 50 years also, nobody can deliver a closed form solution for American option. So Black-Scholes formula only deal with European option, not American option. But on the market, it's very likely they are pricing an American option. And the last assumption is the aggregate supply for option is 0, but the actually aggregate supply option may not equal to 0 on the market. So those are assumptions in the Black-Scholes formula, and those assumptions are often violated. That's why the option price that you calculated based on Black-Scholes formula should be may be different from the market price. Right? So when you come across one of those scenarios, don't panic. It's normal. It's normal. Just that it tells you the limitation of Black-Scholes option pricing formula. And additional concern is the inputs of a model. And there are 5 inputs, right? Stop price, strike price, interest rate, time to maturity, and here it's 100% sure that you are getting stop price, that's for sure, and strike price, that's for sure, time to maturity, that's for sure. And previously we call interest rate is for sure, but here interest rate could be a dynamic term. It may not be a constant term. It may change in the future. And more importantly, this volatility is an ever-changing variable. It's an ever-changing variable. And your estimate of volatility may not equal to future exact volatility. That's why the pricing of your option may be different from market price, because simply you and the market disagree upon its future volatility. And last reason is so-called volatility smart. And when you look at volatility for in the money and out of money option, you find that the volatility tend to be higher for deep in the money option and deep out of the money option. And the money needs option is not variable in Black-Scholes formula, but here volatility is a function of its money needs. And for deep in the money option, deep out of the money option price tend to be higher than what you can get from Black-Scholes formula. And then we call this as a volatility smart, as kind of anomaly, because in theory the money needs option should have nothing to do with the option price, right? But here you see implied volatilities reflecting the option price are much higher on deep in the money option and deep out of the money option. So for deep in the money option, deep out of money option, the market price is very, very different from the one that you can get from Black-Scholes formula, and we call this the volatility smart. So Black-Scholes formula has a lot of limitations, but investors in the market have to deal with their daily business to estimate American option price, right? And they need to incorporate the dynamic nature of the interest rates and dynamic nature of standard deviation, and also they need to deal with the log normal distribution pattern of stock return, right? And I mean it's a generalization of stock return distribution, but on the market you see a lot of stock jumps and diffusion of stock price, so on and so forth. So we need to incorporate all those complicated things into option pricing model. And simply put, before we solve other problems, I mean it's very realistic for us to deal with American option. American option allows investors to access the option anytime they want, right? And the difference between European option and the American option is that the European option is path independent. No matter how stock price evolves between now and the future expiration date, it doesn't affect how investors exercise the option, because investors only have one choice on expiration date. But for American option, it's typical path dependent. It's path dependent. which means that the path that stop price goes through will actually determine how investors exercise their option, because they have freedom to exercise option anytime they want before the expiration date. So the pricing for American option and the European options are very, very different. And the people tried the dynamic hedging mechanism in order to get a closed solution for American option, but no matter how smart they are, how hard they work on it, there's simply no solution for American option. No solution for American option if we follow dynamic hedging analysis. Right. So researchers actually work on the other areas, and they explore the alternative approach to find a way to price American options as well as other types of options. And notably, one solution that works really well is binomial option pricing approach. And the binomial pricing approach is a very smart approach, right? And it's not complicated at all. It looks like a kid's game in order to get option price. And the binomial tree method can typically people use 1-period model, 2-period model to see the nature of binomial tree method, but in practice people use n-period model to make sure that the time interval is as small as possible in order to get accuracy of option price. Now let's take a look at binomial tree method. Let's say let's use an example. Let's say current stop price is $30, strike price is $30, right? And let's use a 1-period binomial tree approach to demonstrate how we get option price based on this the binomial tree method. And then let's say there's a chance that stop price may go up and go down. If it go up, it will go up by 1/3. If it go down, it will go down by 1/4. Right? And you would say the change of stop price is not asymmetric because it goes up by 1/3 but go down by 1/4. But actually, this is a typical symmetric stop price change. And up movement is 4/3 or 1.33, and the down movement is the opposite, right? It's opposite, 0.74. And actually, by following this expression, we are establishing a symmetric stop price change on upside and downside. And actually, we needed to estimate. I mean, it's not 50 to 50% chance that stop price may go up or go down. And the probability here is called a risk-neutral probability. It's a function of risk-free rate and the down movement, up movement magnitude. It's called risk-neutral probability. That is a probability in word that investors are neutral on risk. It's a very complicated concept, but it's called a risk-neutral probability. And here we want to know the probability that stock price will go up or go down, and actually it's a function of up movement, down movement, and a risk-free rate. And here we can do the calculation. The probability that stock price may go up is 55%, and the probability it will go down is 45%. And now you can look at how we can calculate option price, right? And we simply look at a payoff of this call option. If call option go up by 1/3, which means option price will go up to $40 in this case. If that is the case, then given the strike price of $30, the option can deliver $10 of intrinsic value in case stock price goes up, and actually probability is 55%. And there's a chance stock price may go down. In that case, the option will be out of the money, and the intrinsic value would equal to 0. Right. Now you combine both events, 55% chance for you to get $10 and a 45% chance to get 0. So the average value that you can get from this option is $5.50. $5.50. But that $5.50 is the intrinsic value you can get in the future. And the option price should equal to the present value of that expected payoff. So we discount the $5.50 to get a current option price, which equal to $5.14. So this is a very simple binomial tree method to calculate option price. So essentially speaking, option price is the present value of future expected payoff. And here there's two potential scenarios for you to get a future expected payoff. One is stock price to go up, the other one is stock price to go down. Just that you needed to estimate the risk neutral probabilities for those two potential outcomes to estimate the expected payoff. Once you get an expected payoff, don't forget to discount it back to today to get the present value, because that present value equivalent to the option price. And in the textbook, it shows you a very interesting way on how to use the replication of option to get option price based on binomial tree method. And here we have a two-state option pricing example. Let's say stock price right now is $100. It can go up to $120 or go down to $90. And meanwhile, we have option value. And if stock price went up to $120, then it will deliver $10 of intrinsic value because the exercise price is $110. If it go down to $9 and $90, then the option payoff would be equal to 0 because it's out of the money option. So you have two scenarios for both stocks and call options. Right? And here, let's say we compare the payoff of holding one share of stock and borrowing money. Right? When you buy stock, you spend money, but here, let's say you borrow a certain amount of money, which is the loan that you take from the market by paying risk-free rate, and let's say 10% is the risk-free rate. And how much do you borrow? You borrow $81.82. What is that? That is actually the present value of $90 loan. So in the future, you're gonna pay back $90, right? But today you borrow $81.82, and in the future you pay back $90. So in this stock portfolio, if in the future stock price equal 90, and you pay back $90, it will give you 0 value, right, for your portfolio. But in the future, if stock price go up to 120, when you pay off $90 loan, then you will get $30. Right? And you either have 0 or 30, and this 0-32 scenario is similar is exactly equal to the situation that you are facing for this call option. Just that you need in this case, you have 3 call options. So 3 call option position is equivalent to your holding of stock and repayment of $90 in the future. It's equivalent. And the outlay of your stock and the borrowing portfolio, which is equal to $18.18, should equal to the value of the option. Because your value option also have 2 states, $30 versus 0, right? And here you have 3 option, which generate $18.18 of total value. So for each option, the value is $6.06. $6.06. This is a very small, very easy way to figure out call option price. And here the hedge ratio of stock and option is a function of call option payoff when stock price is going up and going down, and also the stock value when it's going up and when it's going down. So US0 is when stock price go up 120, and this DS0 is 90, right? And the CU is call option payoff when it goes up, that is $30, and the CD is 0. So this hedge ratio will tell you the ratio of stock and option in that dynamic hedging portfolio, and you will see the answer is equal to 3. That is what you can see on the textbook. And binomial tree should be expanded if you make your time interval smaller and smaller. And for a typical investment bank, they use 5 minutes interval when they do binomial tree estimation for option price. And I mean, it's really hard to do massive calculation 20, 30 years ago, but right now with an advanced technology, people can do continuous compounding, continuous fashion of this binomial tree to achieve the maximum accuracy of option price. And binomial tree is a very, very smart and useful method, so that we can price not only European option but also American option as well as other types of options. And also we can incorporate the dynamic nature of interest rates, the standard deviation, as well as jump and diffusion of stock returns for the log normal distribution for stock returns. So it's a very flexible and a very powerful way that people utilize to estimate option price nowadays. And the last method I'm going to introduce is Monte Carlo simulation. Monte Carlo simulation actually goes from non-arbitrage pricing argument back to very traditional, very simple discounting mechanism of asset pricing. As we said, option pricing is more complicated. We have to utilize more complicated method like dynamic hedging, non-arbitrage, so on and so forth. But this Monte Carlo simulation actually tells we can use a very simple idea for option pricing, which is cash flow discounting. Cash flow discounting. So the difficulty of option pricing is that in the future there's a great uncertainty. There are hundreds, thousands, even millions potential outcomes for stock prices. That's hard. But we know that with the capability of your software, your computer, you can actually simulate the future scenarios. If you know the pattern of stock return, stock price. And this Monte Carlo simulation actually go back to the very origin of asset pricing, which is cash flow discounting. And essentially, what we do here is we use any computer software. Can be Excel spreadsheet, but most people use SAS or the statistical package to do the simulation. What do they simulate? They simulate future stock price. They simulate future stock price. I mean, the uncertainty means that there are many potential outcomes in the future. So here we're going to simulate all future scenarios. When you say all, it's approximate. I mean, there's no way you can simulate infinite number of scenarios, but we can try as many as possible. Right? We can try 5,000 times. We can try 5 million times. When you try 5 million times, approximately speaking, you are exploring, potentially all potential scenarios in the future. Right, so the more simulation that you do in your computer, is more likely that you capture the future uncertainty. Right? And the mechanism here is you estimate. You simulate all potentially all future stock prices. So assuming that the uncertainty has been dealt with, so that risk is no longer the factor that you need to consider. Right? And on the future, let's say 5 million potential alt accounts, you would say this is a good representation of what will happen in the future, right? So that the risk is no longer there. Therefore, you look at the payoff on each scenarios and take the average. Take a simple average of all future potential payoffs. You will get the expected payoff from this option. And the last step is simply take the present value of this expected payoff to get the option price. And here is the demonstration of this Monte Carlo simulation, and it can be built in this Excel spreadsheet. Right? So this MON is Monte Carlo simulation. What does it simulate? It simulates stock price. How do we simulate stock price? Well, we believe that the future stock price is the function of current stock price. ST equals S0 times a very complicated term, right? And this term allows us to simulate stock price based on its standard log normal distribution. Log normal distribution. And it's R minus standard deviation squared divided by 2 raised of t plus standard deviation times a random term. Random term from standard normal distribution times square root of t. This is the return for stock, which follows log normal distribution. Return of stock follows log normal distribution. And once we apply this term to the current stock price, we can simulate future stock prices. And notice that this is a small e is a random example. Take value from standard normal distribution. Right? And let's take a look at how we can do this in spreadsheet. And actually, we can put the formula here. Put that simulation formula of the stock price here. And every time it will generate a random term between this random term between 0 and 1 based on normal distribution. And once you have future potential stock prices, then you calculate the payoff of stock price. And this payoff stock price is follows maximum function and look at the difference between stock price and exercise price. If it's positive, then we take that value. If it's negative, we take 0 because this is a maximum function. So on this column B, we have all potential payoffs for that option, right? And we can run simulation for 100 times, 1,000 times, or million times. And typically, investment banker will do at least 1 million simulation, right, for stock price and this payoff on the option. Once they get all those payoffs, they simply take average. You see, they simply take average and do discounting to get a call option price. So for this option, let's say stock price $8.38. And by the way, this yellow box, in this yellow box, you put all 5 variables. Stock price, risk-free rate, standard deviation, time to expiration, and this exercise price, right? And it shows you that, okay, this Monte Carlo simulation delivers different numbers for option based on number of simulations. And the more simulation that you do, more accurate the option price it will be. When you do 1200 simulation, I would say it's not accurate. It's not very accurate. But when it goes up beyond the 6,000 simulations, you see, okay, the option price is approaching its best value. And here the maximum I can do is about 12,000 times, just because Excel spreadsheet has limitation on its computation capacity. But if you use SAS or other statistical software, you can do 100,000 times or even 1 million times for simulation without crashing your computer. Right? So this Monte Carlo simulation is the most popular way that Wall Street are using each and every day. in deriving option price. And this Monte Carlo simulation method actually has flexibility because you can adjust this stock return function to allow jump and diffusion stock price in order to generate more accurate future stock prices. So that is a Monte Carlo simulation. Let's take a break, and we will introduce how to use options. To manage your portfolio and take different kind of opportunities in financial market in the next video. Let's take a break.